Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. Today, I'm excited to have JP Conklin, which is the president of Pensford and LoanBoss, two companies. So we got a kind of two for one here. JP, how are you doing today?
I'm doing great. How are you doing today?
Doing well. JP's coming to us live from cold and snowy Charlotte, it sounds like. So I appreciate you coming in through Skype today. So JP, maybe give a little bit of background. We're a client of Pensford. We've not used LoanBoss yet. I know hopefully one day we'll step up and do that. But tell us a little bit about kind of the two companies that you focus on. I know Pensford is a interest rate hedging and derivative company where you guys sell that. A lot of rate caps and swaps and things like that. So maybe kind of talk through the two companies that you run and kind of your background.
Yeah, absolutely. So thanks for having me today. I spent my entire career in interest rate derivatives. I started on a trading floor at a bank called Wachovia that some listeners may not even remember anymore. I left about 12 years ago to start Pensford and basically switch sides of the table. I thought borrowers needed some assistance in their negotiations with the bank, and why not come over and help them understand all the intricacies of those transactions. So that was about 12 years ago, and ever since the business has grown pretty substantially, and we've got a pretty sizable team and a large portfolio of clients that we work with. Typical loan size is probably 25 to 100 million, but we have some loans as small as 5 million and some as large as $1 billion. And our primary area of expertise is anything around interest rates. So if you even go to our website, pensford.com, we refer to ourselves as the interest rate people. We're a one-trick pony. We just focus on things that involve interest rates, and we're there to serve as a resource for any clients who have questions about them and how they might be impacting their financing.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
What is a typical client of yours? I know I'm a client of yours. We're a multifamily investment private equity firm, I guess. And so do you just focus only on multifamily, all sorts of commercial real estate? Kind of what runs the gamut of your client base?
Sure, it's all asset classes. I think multifamily is a huge portion of our client base just because from a transaction standpoint, they tend to do a higher volume of transactions. But we work with all asset classes. So a lot of industrial clients, retail clients, and any other asset classes in between kind of runs the gamut. I think they each have their own things that they have to consider in a financing. A lot of times with Freddie financing, it's pretty straightforward. We just need to go buy an interest rate cap. But a lot of times you're looking at an office building and they might have various disposition plans, and walking through those various exit strategies and making sure that they choose the interest rate structure that makes the most sense given their business objectives.
So let's maybe talk through that. I mean, for those that aren't interested or are familiar with it, maybe talk about the different ways and different products that you guys offer that can hedge the interest rate risk. I know you talked about the Freddie floater. That's a product that a lot of people that buy multifamily really been working on lately. That's a product that I got familiar with. Was by doing the Freddie floater when they require an interest rate cap of LIBOR at the time, and now we've transitioned over into SOFR. But what are the various types of products that you sell, and maybe kind of spend just a brief recap of each one of those and how do they work to hedge your interest rates?
Sure, absolutely. So the interest rate cap is probably the most plain vanilla, straightforward hedge that there is. It's nothing more than an insurance contract or a ceiling on your floating rate index. So as you mentioned, most commonly that has been LIBOR over the years, although we're starting to see that transition over into SOFR, led by the agencies, Freddie and Fannie. And it just ensures that your floating rate never gets above a certain level. So typically the agencies will have some sort of max rate that they don't want to exceed, and they'll use that to back into the strike that you have to buy the interest rate cap at. Very common strike today might be around 2%. So Freddie might say, we don't want SOFR to get above 2%. You have to buy a cap at 2% so that we know your all-in worst case scenario is 2% plus your loan spread. So you pay an upfront premium for that amount. Company like Pensford helps arrange that with a Freddie approved provider. So we go out to the banks that Freddie has said you're allowed to buy this insurance contract from these banks, and we help arrange it. And so you pay an upfront fee, usually gets paid out at closing. You send the cap documents over to the lender. It satisfies the hedge requirement, and you can close on the financing that way. As you move forward, there's never a scenario where the cap could be against you. It only has value to you. So you might pay $50,000 up front the day you close. You'll never have to pay more than that. If SOFR, the hedge provider, reimburses you the difference, and you pass that on to the lender. If it never gets above the strike, you never hear from anybody, and you just move forward with your financing, you'll never know the difference. And if you terminate early, you can pay the cap off and get reimbursed any remaining value for it. So caps are really like the lowest risk, easiest, most plain vanilla structure that we deal with, because there's never a downside scenario. You pay the upfront money, you go about your business. When you switch over to, let's say, a balance sheet lender, that's when you might start to see alternative structures. They can also do caps, but very frequently they will also offer something like a swap. And that was really the structure that I started Pensford on, was negotiating swaps, because they're far more complex than interest rate caps. And so our job is to negotiate that swap and the pricing and the structure and the legal documents that go along with that on the borrower's behalf. So we're not necessarily going to direct the business away from the lender to somebody else. We're there just to make sure that the borrower gets a fair and transparent deal that they're comfortable with, and they go into it with their eyes wide open. Far and away, the biggest consideration when you're entering into a swap is, what does a potential prepayment penalty look like? And for your viewers, they might be familiar with yield maintenance or defeasance. It's the exact same type of calculation. You've locked in one rate, and if you go to prepay, if rates have gone down, you owe the bank the difference. If rates have gone up with a swap, the bank will pay you the difference. And so it's really important to negotiate what it looks like going into the swap, because that's going to impact whether or not you owe them or they owe you, and how much you're going to be paid. So the first question I always ask people when they say, should I lock in for the full 5, 7, or 10 years is, what's your plan for this financing? If you this financing in 3 years, you probably shouldn't consider a 10-year swap. Conversely, if you think you'll actually be in this financing for the next 10 years, a 10-year swap could make a lot of sense. And generally speaking, the longer the term, the more attractive the swap looks relative to the cap. Caps start getting very cash expensive after about 5 years. So you don't see a lot of 10-year caps. We do sell them, but you don't see a lot of them. Conversely, you almost never see swaps for less than 3 years, because caps are so cheap. It just makes it very easy. So I'd say that those are by far the two most commonly used hedging instruments in the market today. Caps, primarily short-term floating, 3 years or less. Swaps are longer term, convert a float to a fixed, generally 5 to 10 years.
And so the difference between the yield maintenance or defeasance prepay and the swap, it sounds like that you can actually benefit monetarily if you have a swap, because there's some value to that contract, where the yield maintenance or defeasance only benefits a lender if I prepay it and then I have a 4% rate and rates go to 6%, and the yield maintenance is very, very minimal. It really only goes to benefit the lender, correct?
Yeah, exactly. So there are extreme scenarios in defeasances where you could get paid. It's just that you almost never see it, because the spread on top of treasuries or swaps when you locked in the rate is against you day one. So you don't just need rates to go up, you need them to go up by more than that spread. So if it was treasuries plus 2%, you need rates by more than 2% just to get back to zero.
Got it.
With a swap, you don't have that spread working against you. So day one, absent profit that the bank makes, this thing is basically neutral to you. So the minute rates start rising, it could be in the money to you. So we've had clients who have executed swaps since COVID hit. Now that we've seen rates pop back up, these swaps are now in. And so they're looking at it and saying, you know what? Maybe if I think I'm going to get out of this financing in the next year or two, maybe I go ahead and terminate the swap, get my money back, go back to floating, and save some money by being floating on top of the breakage cost of the swap. So it just offers a lot more flexibility, but it also is a little bit more complex and has more considerations. So it's important to talk through those so everybody goes into it wide open.
Yeah, that makes a lot of sense. So besides those products, is there anything else that maybe kind of the third or fourth that you product that you guys sell that maybe fits a certain situation out there?
Yeah, so I would say the next most common is probably a swaption, which is just an option on swap rates, generally used for customers who are placing fixed rate debt at some point in the future, but they're not really sure which bank they're going with or exactly when they'll be closing. And they're just mostly worried about, let's say, 10-year treasury yields moving up. So they may say, listen, I want to pay an upfront premium today to protect against the 10-year treasury moving above 125, 150, 175, whatever that number may look like. And so they can say, let's protect against the 10-year treasury being above 2% a year from now. Let me pay you an upfront premium, and then I've basically hedged myself anything above 2%. We also use that very frequently on defeasances, where you actually want to protect against rates moving down. So we've had borrowers who say, hey, listen, rates have popped up. My defeasance or my yield maintenance has suddenly gotten much more affordable. Can I go ahead and pay this off? And the answer is yes, but if you're worried that rates are going to drop back down in the next 30 to 60 days while you're closing, you might want to consider a swaption to hedge against falling 10-year rates between now and closing, and just try to lock in that premium that you're going to pay on that. So swaptions are another common discussion. And I would say probably lastly is a collar, where you basically want the flexibility of floating rate exposure, but you also want a. And so rather than paying up front with like you would with a cap, you have a ceiling of, let's say, 2% and a floor of, let's say, 25 basis points. You just float between those two numbers. It'll never get away from you, but you might not benefit from when it's below 25 basis points. Not that dissimilar from a floor for some people. The biggest advantage over that versus the cap is you don't have to pay an upfront premium. So if somebody doesn't want to send 50 grand out the door in cash, might look at a collar.
Yeah, it's very good. So what you have many different clients, a variety of asset classes in the commercial real estate space. What are kind of the most popular loan products that you guys are being brought in to kind of help mitigate a lot of the interest rate risk? I know, as we record this, we're kind of halfway through the first quarter of 2021. The latter part of 2020, we had a pretty healthy decline in both short-term and long-term rates. And over the last, 2-3 months, we've really kind of seen the 10-year treasury kind of steadily climb up from the lows that we had in third, fourth quarter of 2020. Has that, so what are kind of the most current products that debt instruments that your clients are out there actively engaging in? Is that different than, say, 6 months ago?
Yeah, so 6 months ago and even 3 months ago, far and away, the biggest volume was Freddie floaters. The agencies really stepped up post-COVID to make sure that there was liquidity in the housing market, and that flowed through to the transactions that we were seeing. And I'd like to remind our team, like, that's why we pay taxes. Is that's when the federal government, the agencies can step up and fill in when the private market, such as traditional lenders, are more reluctant to do so, right? And so I try to remind ourselves that that's why we pay those taxes once a year. I would say what we're seeing now is a shift, and banks, particularly regional banks, are starting to get more aggressive again. I think that the largest banks are still going to be very cautious. They probably have their short list of clients that they're willing to lend to, but you have to move a little bit further downstream to the more regional banks, and a little bit larger than community banks, to really see a pickup. They're filling that void, and they're coming in, they're saying, you know what, we're starting to dip our toes in the water. We got through 2020 okay. We're starting to feel like maybe the banking regulators are going to loosen up a little bit on us this year. We've done well with the stress test, And so we've seen a lot more activity out of regional banks who are, typical financing might be a $10 million deal, LIBOR plus 2 or 2.5, and they're proposing swaps to our clients. And most of the time, these regional banks aren't big enough to have their own swap desk. So they've actually got something behind the scenes in the industry, we call it a back-to-back, where they've arranged for a larger bank, think of any bank that you can name, who basically is serving as the outsourced swap desk for them. And so for our clients' perspective, they still face the regional bank, but it gives the regional bank the ability to be more competitive on a rate standpoint and offer a swap without the overhead of an entire trading desk and back office operations for that. So I would say that Freddie is still the vast majority of our volume, but we're seeing a huge tick up in regional bank lending and subsequently swaps that go along with those.
So with a changeover on the types of debt over the last, say, 6 months, I know we talked about the interest rates. 10-year Treasury got as low as in the high 50 basis point range, maybe 60 basis points, and now as we record it, we're kind of 115, 120, something like that on the 10-year Treasury. So probably doubled off the bottom approximately. What has that done to the pricing of these things? Because the LIBOR and SOFR caps, the last ones we bought in the fourth quarter of 2020, were exceedingly inexpensive. It was immaterial amount of money relative to the overall cost and size of the deal.
Yep.
Has that kind of widened out here over the last 3 or 4 months?
Nope, not at all, because caps, particularly for a Freddie financing, are generally going to be 3 years or less. And so the front end of the curve is so directly controlled by Fed monetary policy that even though the 10-year part of the curve has popped up, the curve is still firmly anchored close to zero, anywhere between 15 and 25 basis points, because the Fed has made it abundantly clear, no intention of raising anytime soon. So you really have to go out 3 years before the market even starts pricing in one hike. Even though that's earlier than what the Fed is saying they plan on doing. They're really targeting 2024 before they start hiking. So from an interest rate standpoint, if you're offering an insurance contract at 2% on LIBOR, and the people that control LIBOR and SOFR are saying, we're not going to be anywhere near 2% for the next 3 to 5 years, it's still cheap. So the 10-year part of the curve has popped. And so we're seeing people who were maybe looking at, a CMBS or a Lifeco deal, maybe even a 10-year swap, are now starting to look at the floating rate alternative and saying, hey, now that I can pick up a point, should I think about doing a floating rate deal instead of the fixed rate deal? So the steepening of the yield curve has caused people to do some analysis that they weren't really doing 6 months ago. 6 months ago, if you could fix at one rate or float at one rate and they're identical, most people by default just choose the fixed. It feels safer. Now you can pick up a point by floating. And so it's causing people a little bit more thoughtful about what is the appropriate selection here before I move forward and just say, lock it in for be done with it.
Before I kind of get your overall thoughts on the interest rate market and expand upon that, have we seen spreads move around at all now that the 10-year Treasury's basically doubled over the last 6 months or so? Because like you said, if you go back 5 months ago, you float it, you fix it, you're basically 3%, irrespective of the duration of the deals, floating or fixed. We're both the same. Now that the Treasuries run up, have we seen the spreads compress on the fixed rate? And what are you seeing on the floating rate? Have there been any real movement over the last 6 months or so on the spreads on the floating debt?
Yeah, we've seen spreads come in, not dramatically, but they have come in. And it's a little challenging to bifurcate between whether or not that's a result of 10-year Treasury spiking or rolling into the new calendar year. A lot of times you'll see lenders start getting more aggressive after the new calendar year, particularly when there's such a severe downturn as we saw last year. So I think it's a combination of interest rates rising, the yield curve steepening, plus banks did reasonably well last year. I think defaults were far lower than they expected. And so maybe they are coming into this year a little bit more optimistic than they thought they would be. And we're seeing that reduction in loan spread pass through to our borrowers on both fixed and floating rate options.
And so, are you still seeing a lot of these regional banks? You don't have it so much with the agencies, well, certainly with Freddie on the floating side. Are you still seeing pretty high LIBOR or SOFR floors put into these loan agreements?
Yeah, absolutely. And that is always a point of negotiation because you should expect those floors to come into play for the life of the loan.
Yeah,
The last time interest rates were at zero, it took about 8 years before they were able to get off of zero. We should not assume that we will be off of zero within 3 to 5 years. There is a very real scenario where LIBOR is still anchored around zero 6, 7 years from now. So if you have a floor, it has real economic impact. If anything, we've seen the floors come down as borrowers have had more options between lenders. 6 months ago, 9 months ago, if the lender had a floor of 1% on LIBOR, you were stuck with it. You were taking that deal. Nowadays, you can probably line up a couple different lenders. This becomes a point of negotiation, getting it as close to usually 15 basis points as possible.
got it. So now that we're kind of almost a year into the whole COVID thing, the world's kind of getting back to normal. What maybe talk through kind of what the market is expecting for interest rates, and then obviously you're a man that pays attention to this on a daily basis, really, and you have certainly a lot of opinions about whether the market's right or the market's wrong. So maybe kind of talk through what do you see for the kind of the intermediate term for both what the market expectations are and your personal expectations, as well as kind of maybe the intermediate, maybe a 5 or even a 10-year horizon. Kind of what do we expect going forward for both the short end of the curve and the long end of the curve going forward?
Sure. So let's talk about the market expectations first. Market expects the Fed to be on hold through at least 2023. It starts pricing in one hike towards the end of 2023. And that is the direct result of Fed forward guidance. The Fed is saying we don't plan on hiking until 2024. The market is maybe disbelieving that slightly, but not a lot. So basically saying maybe we have one hike towards the end of 2023. Even if you go out to 5 years, however, the market has LIBOR peaking at 1.25%. So it's going to be a very long, slow, protracted cycle before we see the front end of the curve, floating rates like LIBOR or SOFR, drive up meaningfully to a point where somebody might want to pick a fixed rate over the floating rate alternative. On the long end of the curve, we've seen rates pop up over the last few weeks. 10-year Treasury got up close to 120, highest point since COVID hit, and the reason is because of stimulus. The market interprets that as we'll see stronger growth, stronger job market, and then inflationary pressures. Not to mention, you have to pay for that somehow, which is something my kids still haven't wrapped their brains around. They just assume you can keep spending forever, and nothing bad ever happens. So the market is interpreting, ever since the Democrats swept Georgia in that surprise election, that greater chance of a $1.9 trillion stimulus package getting passed on top of the one that was passed in December, and you're dealing with gigantic numbers. Like, such big numbers is tough to wrap your brain around. And the market's conclusion is that must lead to greater deficits and therefore greater inflation. And so inflation is public enemy number one for bonds. And that suggests get out of bonds. When I sell a bond, the interest rate rises. And that's why we saw the 10-year hit its one-year high, right? I think that it is not the beginning of a runaway freight train. If you look at market expectations for the 10-year Treasury at year end, it's around 1.35%. It's not dramatic. Goldman recently revised their forecast up to about 1.5%. B of A came out last week and they revised their year-end forecast up to 1.75%. So there's no doubt that there's upward pressure, particularly as the vaccine takes hold. If that plays out as we expect and the second half of this year we are largely back to normal, then we're going to have upward pressure on Treasury yields. I personally am not convinced that this is a way freight train because the rest of the world is still dealing with either zero or negative interest rates. Rates look amazing relative to the rest of the world. And every time they tick up, they look that much better than they did the day before. Money flows into them and pulls those yields back down. I think maybe one of the biggest concerns that most viewers will have is inflation, right? What is all this going to do for inflation? And I think inflation is dramatically overstated in the next 3 years. I don't see any scenario where we have an inflation problem. I think the Fed would love to have an inflation problem. The Fed feels very confident it can control inflation. If they really had to, they'll hike a couple times. They'll talk about unwinding QE. We'll see all of that grind to a halt pretty quickly. They would love to be dealing with an inflation problem. They're way more focused on disinflation or deflation. They're really concerned that they can't get out of this, just like Japan hasn't been able to get out of it, just like we couldn't get out of it after the great financial crisis. And so one of the questions I always put back to my clients who say, hey, what about inflation, is everything the Fed is doing is a page out of the playbook from the financial crisis. And we did not have inflation after the financial crisis. In the 10 years following the financial crisis, inflation hit 2% exactly 3 quarters. The Fed would love to be able to get back up to 2%. I suspect that because we're bouncing off of such a abrupt, sharp bottom, that we will actually see 2% or higher inflation this year. It will not be sustained. You will be reading things in the Wall Street Journal or the talking heads on CNBC talking about inflation. Is this something to be worried about? And I believe very strongly that we'll actually see that inflation retract and come back below 2%. Even if I'm wrong, the Fed has said that they are comfortable with inflation overshooting 2% and that their new guidepost is they want inflation to average 2% over the long term. So in the past, it's been once it gets to 2% or approaches 2%, they start talking about hiking, the market starts pricing in hikes, and what they have been abundantly clear about this cycle is that is no longer the case. From here on out, we have to overshoot 2 to make up for all shooting, and we're not going to start considering hikes until inflation is averaging 2%. That, I think, is going to be a decade-long problem. I think we are in this cycle for the foreseeable future, and I do not see inflation being a consistent concern over the next couple of years, even though I suspect it will grab headlines at some point this year.
So when you talk about inflation, you're talking about CPI or core CPI, the consumer prices, your day-to-day goods. How do you then weigh that with what I've seen in my day-to-day life, where in Dallas, Texas, you look at a multifamily deal that 8 years ago we bought for $30,000 a unit. Then I sold it, a few years ago for $50,000 or $60,000 a unit, and it sold again for $80,000, and then today it's worth $100,000. And then you look at all-time record pricing in the stock market, et cetera. I mean, obviously a lot of that's the interest rate and debt driven. So there's not consumer price inflation. But if I look at my day-to-day life, and what I do and what a lot of your clients do, which is buy multifamily and commercial real estate, I mean, the prices and valuations have just been skyrocketing. Maybe kind of talk through that, and what do you anticipate when you say the Fed would love an inflation problem, but we're seeing asset price inflation and kind of furthering the wealth gap of those of us that can borrow money versus and buy income producing multifamily properties versus those of us that can't.
Yeah, I mean, you hit the nail on the head. That it is all of these asset bubble creations are all around asset owners. Particularly those that use leverage to purchase those assets. That's why real estate has been so hot for so long. Was not only was it extremely low interest rates, which make financing and borrowing insanely cheap. I've got a mentor that told me when interest rates are at 0, if you can fog a mirror, you can make money in commercial real estate. And he's in commercial real estate, and so he's making fun of himself, saying, like, it's just a good time to be a borrower. Right. But compounding that is this Fed monetary policy of quantitative easing, where they're just flooding the system with liquidity. And so all this money has to go somewhere. And that's why real estate as an asset class has gained so much traction in the last decade, because that money's just looking for a place to invest. And when the 10-year Treasury, a year ago is yielding 55 basis points, commercial real estate looks pretty darn good relative to that. And when the Fed has said, hey, listen, we're not going to let the 10-year Treasury get beyond a certain point, we'll intervene and keep a lid on that. Why not consider commercial real estate as an alternative to that? So I think that anybody who is a borrower or an asset owner has disproportionately benefited from low interest rates and Fed monetary policy. And I would expect that to continue. I suspect a lot of the tenants in some of these multifamily properties do not feel that they have benefited as much as the landlord has. It does not change how they are spending their take-home pay week in, week out. And so to conclude with your point is, there's no doubt that this has exacerbated the income inequality in this country and has really highlighted that there's a difference between asset owners and borrowers and pretty much everybody else. And so while some things may be slightly more expensive, day in, day out, most things are not dramatically more expensive than they were even 10 years ago, except for those things that are driven by liquidity, 0% interest rates, and asset bubbles.
So, I mean, yeah, you think about it, we've had all these national headlines about eviction moratoriums, and that's, impacted collections to a certain degree, pretty muted in the Texas markets I play in, probably a little bit more pronounced in, San Francisco or New York City or one of the kind of gateway coastal markets. But with our decision a few years ago of just taking exclusively floating rate debt and buying the cheap interest rate caps like we talked about, I mean, our spreads were, we got some stuff anywhere from, like in the mid 150s over LIBOR up to kind of like the 200, 210 over LIBOR. So with LIBOR going from, what was LIBOR like a year ago, it was north of 1%, 1.5 or pushing 2% a few years ago. And now, it's 12, 15 basis points. And so for 6 or 7 basis points, I mean, we're making more money today than we ever have, even if we're having some higher elevated delinquency and collection issues, just because that our interest rate got cut, nearly in half in some respects along the way. So it's a perverse system that we seem to find ourselves in, that they're talking about the income inequality, and not to get too political, but then all their policies and everything they're doing is just doing nothing but to exacerbating these issues that they're trying to fight against. And it's just I don't know how we get out of this whole loop. So I don't know if you have the answer to it, but it seemingly is a real problem, and I don't see us getting out of it really anytime soon.
I would say, just to put a bow on that, is all of these benefit owners, and I'm in this industry, so this is near and dear to my heart, is driven by FOMC monetary policy, right? And the lesson that we have learned, hopefully, from the financial crisis was the Fed intervened to be a backstop, and they were able to move quickly and basically provide liquidity and stability in the market. But Congress never allowed the FOMC, the Fed, to back out of that emergency measure and just realize we can force the Fed to do all of our dirty work for us. We don't have to reach across the aisle and work together, because we'll just punt to the Fed and make them keep bailing out the economy. And so the Fed got stuck in this vicious cycle of being really the only agency of the government that was trying to do something about the economy. This time around, if the Fed can extricate itself from the emergency measures, the quantitative easing, the 0% interest rate, and pass the baton back to Congress to say, okay, now it's your job to help spur economic growth, I think that's where we might see a more dramatic impact on the bottom line of GDP, and less inflation and bubble creation in things like stocks and commercial real estate. We really need Congress to step up, play nice with each other, and figure out a way to help the people who are tenants in these properties, not just the property owners themselves.
Yeah. So two little last topics before we kind of wrap up the conversation here, JP. You mentioned, a little bit ago how you anticipate interest rates being on the short end of the curve for sure, low for the market saying 3 to 4 years. You're thinking 8 to 10. Is it? Did I summarize that correctly?
5 to 7. I'd say 5 to 7.
So if I am, which I am, I'm a guy who buys multifamily properties, and I'm looking to have a 5-year hold period. And all things being equal, would you advise me to float, or would you advise me to consider fixing right now with what you know in the first part of 2021?
All things being equal, I would advocate for floating. Put a hedge on it just in case I'm wrong. But I think there is very low downside, particularly if you don't have a floor, of just floating. I think the Fed gives the economy a lot of rope before it starts hiking, and particularly if it's going to cost you a point to fix today. And what you would need in that scenario is really for them to hike 8 times just for it to average the 1% premium that you're paying. So in a different world with a less transparent Fed, I might have concerns. The Fed is committed to transparency and signaling their intentions way in advance. We will know a year ahead before they start hiking. So my guess is at some point in 2023, they start saying, hey, we're going to be considering hiking at some point in the future, and that usually means a year plus out. You'll have plenty of lead time before they start actually moving interest rates.
What if my hold period is 7 years? Would you have the same answer?
I would say, what's the probability that you don't actually hold it 7 years? You know, sometimes
pretty high. No, most commercial real estate guys.
That's the thing is like everybody says, oh yeah, I'm going to be in it for 7 to 10 years, and they never are. And like we did an analysis for one of our borrowers where they always did 10-year fixed, and it turned out they were holding things normally for 3 to 4 years. And so we didn't convince them to start doing floating. We convinced them to consider shorter term fixed to at least mitigate some of the prepayment penalties that they were paying, because it was a huge number. And when we quantified that in terms of if we had rolled that into the rate on the front end, if you knew that that penalty was going to increase your interest rate by 2%, would you have chosen it? And the answer was, of course not. We never would have done that. Well, let's be mindful of that going into a financing on the front end to say, am I really going to hold this? Or if I'm honest with myself, do I tend to turn things over in 3 to 5 years? And if that's the case, maybe I should consider floating.
So final question here before we kind of wrap up. You know, we're in the process or the midst of the transition from LIBOR to SOFR. I know Freddie Mac is kind of the agencies are leading the charge with not offering LIBOR-based loans, and now we are able to buy interest rate cap on SOFR, where 6 months ago that didn't exist. Any sort of thoughts on kind of the timeline or any kind of just real high-level brief impacts that you anticipate over the next couple of years on the transition?
Yeah, so I think the agencies will continue to be leading the charge. And then by the end of this year, I suspect most banks will be trying to do new deals using SOFR instead of LIBOR. I think that the legacy contracts, that if you've already got a deal out there that references LIBOR, they've already punted the transition date to mid-2023. And I would not be surprised if they punt that even further and just kind of let legacy LIBOR contracts sort of fade to black over time as they mature, and instead really focus their intents on the lenders doing new deals referencing SOFR instead. I suspect if you and I do this a year from now, most new term sheets are going to reference SOFR. And so I think for your viewers, they're going to see a lot of term sheets this year that start referencing SOFR, particularly as we get into the back half. The net effect is negligible. It will feel and act a lot like LIBOR for most borrowers. So I don't think it's going to change much from that standpoint. It's just going to be something that they're going to have to be cognizant of as they move forward. And then they'll probably dig in and realize, okay, it's not that much different. It is probably going to feel about the same. And the last thing I always lead our customers with is such a regulatory spotlight on LIBOR and SOFR transitions. I do not expect banks to try to use this as an opportunity to take advantage of something. I think this is one of those things that everyone's just going to work together as best as possible and try to make this as smooth as they can, because no one wants to deal with the hassle over a couple basis points in transitioning from one index to the next.
Well, JP, appreciate you coming on. And if anyone's watching listening this long into the show, I think you probably realize what I realize. JP is a very seasoned interest rate professional. He's who I use personally when we need to go buy a cap for any sort of debt, or consult when we're kind of debating between fixed and floating. So JP, if people want to find out more information of you, maybe give a resource how to connect with you, maybe talk about the Pensford letter and the Rate Guy podcast. I'm a big fan of both. Maybe kind of give the listeners a couple of resources on how they can find out more information about you and Pensford.
Yeah, if you go to the Pensford website, pensford.com, you'll find links to all of that. We put out a weekly newsletter with relatively irreverent approach to things. I'm not a PhD. I can't write above my pay grade. So I try to keep it relatively straightforward so that even somebody like myself can understand it. Additionally, I do a podcast each week, same place you can go and listen to podcast. Just trying to keep it light. We try to talk about the things that people care about and then let them get back to their day. And if you want, really authoritative source, you can go to the Wall Street Journal and listen to the experts. But yeah, just go to pensford.com and you'll all that information.
Well, for JP Conklin, I'm Michael Becker. I appreciate you guys watching. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.